Hello everyone, welcome back to my channel, RAJAT Bose from Kolkata. Welcome to those who are coming for the first time. Today we have an important thing to discuss. As an investor, what do you look for while studying a company? How to go about it? Where to begin? All these things we would cover today so that you have an understanding of the company that you are going to buy. You first need to begin at, is the company really growing? When we say the company is growing, we essentially mean two things. That is the growth in top line and the growth in bottom line. What constitutes the top line? The top line is actually the sales number. Top line is the revenue that the company generates. It is the gross revenue that the company generates that comes to the top line. You have to see whether top line is growing on year-on-year basis, whatever the company did last year and how is the company doing this year, that you need to look at. And then you should be looking at how is it performing quarter on quarter, because quarterly results are published. So if there is growth, the company is likely to show quarter on quarter growth. When I say quarter on quarter, it means that the last quarter, say you are taking the June quarter, that is generally the first quarter for most companies. June quarter last year, June quarter this year, September quarter this last year, September quarter this year. That way you actually find out whether there is quarter on quarter growth. Then growth is also studied from the point of view of every succeeding quarter. If it is growing, this is the best possible thing that can happen to a company, that every quarter its sales are increasing. That is how you look at the top line. Now, same thing should be applied to the bottom line. What does the bottom line mean? Bottom line is actually the profit after tax or the net profit figure in any balance sheet, in any profit and loss account. So when you are looking at the income statement, look at the PAT figure. Is it growing year on year basis? How do you get that? How do you get this information? This information is published in websites, published in the BSE, NSE websites, as well as the company websites. Also the company comes up with PDF that is sent to the exchanges. These are the places where you should seek this information. Again, apply the same methodology. Quarter on quarter growth means last year second quarter, this year second quarter. How are the companies performing? That is how each quarter should be considered with the same quarter last year. That way you can study whether the company is growing. And now if you go back several years, then you can actually see how the company performs in the first quarter, in the second quarter. Is there any trend or not, both for the sales figure, that is the top line, as well as for the bottom line. You should study. This is your first step to understanding a company and its performance. As a company, or if you have any idea about a business actually makes money increasing sales and then decreasing its expenses or keeping the costs under control. That is our second thing that is we should be studying. If the costs are kept under control, because the more the expenses are, the gross profit figure and the net profit figure all will suffer, because first of all we are looking at how the company is performing at the operating level. And if the costs are controlled, by the way, cost does not mean only cost of goods sold. Cost also means whether you have taken interest and you have taken loan and the interest payment that you incur every year on that loan, that actually that money is also deducted from the gross profit. Finally, at the net profit level, all the deductions that have to be done, they are gone. Like for instance, there would be taxes, there would be depreciation, there would be interest cost. All these are deducted from the operating profit level, and then finally you come to a net profit figure. So we need to see whether the expenses are under control, whether the costs are under control. That's the second point. Another very important question to handle is, we would like to invest in a company that is already making profits. Of course, for startups, for certain companies which requires long gestation periods, especially say those infrastructure companies, they take a lot of time to actually produce a positive bottom line, or they generate profits at a much later date. So not all companies can be judged from this particular criterion, but we would like to see whether the company that we are investing in is already making profits. If it is making profits, then how much profits they are making, what is the net profit margin. That is, when you look at the PAT figure, and then dividing that by the sales figure, that is the bottom line divided by the top line, you will get an understanding of what is the PAT margin. How much for every 100 rupee sales that the company generates, how much profit, how many rupees of profit the company actually makes, and whether you can find a particular trend over a period of several years, or you should also consider that for every 100 rupee sales, the peer group companies, that means the companies that are engaged in similar kind of businesses, how much profit they are making and how much is your company, that is the company under study, is making. So this is a very important point, keep it in mind. Well, we are now back again, and this time we just discussed a bit earlier, that is whether the company is making profits or not. Sometimes you will find one strange thing. What is that? The company is making profits, company is showing good amount of PAT figure, the bottom line figure, but in terms of dishing out dividends, the company may not be so forthcoming. It could be that they are actually deploying whatever profits they are generating into reinvesting it, and so that the company actually makes greater profit going forward. But at the same time, one needs to see, because if cash is generated and cash is handed out to the investors in the company, that also gives some kind of a confidence to the investor. But still, whether you get any dividend or not, you actually try to look at the cash figures. Cash figure means that primarily there are three ways you can actually generate cash. That is, first is the operating level, that is you are selling your goods and services and you are deducting the cost of goods sold and also any other operating expenses incurred, then you get an operating profit. So how much cash is the company generating from operating activity? So that is the basic figure that you look at, and after that you deduct the capex, how much capital expenditure the company is incurring. The net figure that you get is the operating cash flow or free cash flow. Free cash flow is something that Warren Buffett considers to be the very important thing, because this is where you will see that the company at the operational level is cash positive or not. This is a very important criterion, keep it in mind. Is the company incurring debt? Is the company taking debt? That is the company borrowing money from the market? When you as a shareholder, if you have participated in the initial public offering, your money company got and that goes to the equity capital, you hold equity shares of the company. But apart from that, the company also borrows. Company sometimes borrows. Borrowing actually helps in one thing, that is your return on equity can be enhanced through borrowing. Of course, that's not the very right thing to do always, because return on equity should be made higher when you produce that from your asset turnover and other things. But still, actually cost of capital for equity is always higher than cost of debt. That's why companies sometimes take debt, especially those companies which would be in the infrastructure segment, which are in the long gestation kind of projects. They will have to borrow willy-nilly, because no shareholder would like to wait for 8 years committing big money. So debt is an important thing in companies financing their projects. But is the company incurring debt and judiciously using it, or is it going for some unrelated diversification or certain other things that actually may not generate so much of profits? So from that perspective you need to look at, and if the company is taking debt, is it going to, would it be able to service it properly? That means that is its operating profit, or what you call earnings before interest and taxes. If that is at least 4 times the interest payments that you have to make, that would be a very good thing. So check it out if the company has taken too much of debt, or if the company the kind of debt that it has taken, it is being able to service it properly or not. That's very important. Otherwise the company might be in real trouble going forward. Now the next thing that you should look at, whether the company is utilizing its assets properly, and the company's market value, how much of it is backed by the assets. That is, company in this, when I am talking of assets here, I am talking of the fixed assets, because fixed assets are something, it is actually for so-called old economy companies, the fixed assets are much greater compared to say new economy companies like software companies or technology companies. There the fixed asset may not be so good. But suppose if you take say companies that are in FMCG, companies that are in commodities, or say metals, minerals, all these companies will have much larger fixed assets. How are the assets getting utilized? You should actually see the total value of the assets after depreciation that is found in your balance sheet, and then try to come up with this asset turnover ratio. That is, how many times the asset value, there is an asset value after depreciation, how many times the sales figure is over that asset value. That is a very important thing. So check it out if assets are properly getting utilized, or how much is market cap, that is the price at the price of the company in the marketplace, how much is it backed by real assets. Of course, as I said, there are exceptions where real assets may not be as valuable. Now another thing is that you have to understand the balance sheet as well, and look at the balance sheet, and also study the company's schedules in the annual report. Annual report you can download from BSE, NSE websites, or the company's websites in the investor relations menu. From there you try and find out, read the schedules given after the balance sheet and profit and loss account and the cash flow statement. When you read them, you will sometimes find that there is some deferred, there is some tax issue, some litigation, or there is some other dispute, or there is some leasehold agreement that is actually an off-balance sheet item, meaning that it is not finding its place in the balance sheet, but there is a liability there that the company would have to assume because of the contractual agreement for that particular thing. These are potentially dangerous stuff, but you should be mindful. It isn't as if such things are present you should not be investing in a company, but you need to consider that very closely, and come to an understanding that despite them, the company is otherwise still very good. We all know about great CEOs. We all know that they are, in some cases, they become cult figures like, say, Steve Jobs at one point of time, Jeff Bezos of Amazon, Elon Musk of Tesla, and in country where you have Mr. Mukesh Ambani, or say Gautam Adani, or say professional managements like, say, Hindustan Lever or ITC, their CEOs. You have to study the management of a company. How would you go about studying the management? Whether your money is actually being utilized properly or not. And especially if a CEO, you would study a CEO first and foremost. What Mr. Buffett says is his or her ability to allocate capital, which would actually generate higher earning potential going forward. If that is something that is not being done, if the company is only managing from quarter to quarter and always running for some extra profit at the end of the quarter, that means this company will not be or is not being so focused on long-term wealth creation. Long-term wealth creation should happen only if the top management team allocates capital to such kind of projects or activities that would generate higher income going forward. Not just the current moment, but also you have to take care of the future. And if the management is judicious enough, then the management doesn't actually foray into areas where its competences are not very good. I'm actually referring to unrelated diversification, where the company's competence is not really well tested, or sometimes it could be a totally virgin area, or an acquisition that the company is making in which it did not have any kind of expertise as such. And especially unrelated diversification in the form of new acquisition is actually a red flag. Say, suppose if a company that is engaged in FMCG kind of activity and that is going into infrastructure or something, that should be very clearly studied, whether from your studying the management point of view. And also there is one more thing. If you are actually investing in a group company, and if the management is actually borrowing from the same group company, and it is also giving loans to the same companies in the same group, this kind of very complex operations where the group companies are lending amongst themselves, this is best avoided, because you would not be able to gauge actually as to how is the date performing, and how is the capital structure decisions being taken, and what is happening. This becomes a very difficult task for as an investor. Of course, there are people who can definitely do this, but to start with, avoid such companies and groups. Hello everyone, welcome back to my channel. We have an important thing to discuss. What do you look for while studying a company? A business actually makes money. Free cash flow is something that Warren Buffett considers to be the very important thing. Hello friends, we are here to study companies, we are here to study industries, we are here to study the markets. Welcome back. We had been discussing several aspects. We have discussed a lot, but now there would be some investors who would be looking for some regular income from the company. That means these people expect some dividends to receive from the company. Can you expect a reliable income from the company? In such cases, you have to go for companies that actually dish out good dividends. How do you go about companies that will dish out good dividends? Of course, the dividend figures over the last several years, that will tell you that the company actually dishes out good dividends to the shareholders. But at the same time, also study what is the percentage. What is the percentage of retained earnings, and what is the percentage of payout? say suppose a company is actually making 10 rupees as earnings per share, out of which the company gives away dividend in the form of 8 rupee 50 paisa and retains 1 rupee 50 paisa. So that means payout ratio is 85% of earnings, and the company retains only 15% of its fresh earnings to put back in some business or the other. So if the company dishes out 80-85% kind of money to the shareholders, you know that you can expect a regular income, and such companies are generally blue chip companies, and such companies tend to be in say FMCG, automobile. There are companies that actually dish out such high dividends. So you can choose. If you have dividend as one of the criteria, then definitely go for companies that have high dividend payout. All this while, we have actually taken care of several criteria, right from the top line, bottom line, how it is handling debt, how is it handling expenses, and so many other things as to how capital allocation is done. So these are the things you need to study before you decide to invest in a company. I sincerely believe that you would have liked my presentation. If you did like it, press the like button. Also, if you haven't subscribed to my channel already, please do subscribe, and don't forget to press the notification button as well.